The iShares Core S&P 500 ETF, IVV, is one of the largest and most popular ETFs, designed to track the performance of the S&P 500 index. This index represents 500 of the largest publicly traded companies in the U.S. By investing in IVV, you're essentially buying a piece of the overall U.S. economy, making it a go-to choice for investors seeking broad market exposure. IVV holds companies from diverse sectors, including Apple, Microsoft, Amazon, Tesla, and Alphabet Google, in technology, along with major players in healthcare, consumer goods, financials, and more. It's a passive ETF, meaning it aims to replicate the performance of the S&P 500 rather than trying to beat it. This approach keeps costs low while delivering returns that closely match the index. One of IVV's standout features is its low expense ratio of 0.03%, one of the lowest in the industry. For every $10,000 invested, you pay just $3 annually in fees. This means more of your money stays invested and grows over time. Over decades, these low fees can make a huge difference in your portfolio's overall performance. Historically, the S&P 500 has delivered annualized returns of about 8 to 10% over the long term, though individual years can vary. For example, if the index rises by 10% in a year, your investment in IVV would grow by roughly the same percentage, minus the tiny fee. Similarly, if the index drops by 5%, IVV's value would also fall by around 5%. One of the biggest advantages of IVV is its diversification. It holds 500 companies across multiple sectors, reducing the risk of any single company or industry affecting your portfolio too much. For instance, if the tech sector underperforms but energy or healthcare stocks rise, these gains can help balance out your overall investment. IVV is also highly liquid, meaning you can easily buy or sell shares during market hours. This makes it suitable for both long-term investors building wealth and short-term traders looking for quick moves. It's a great option for retirement accounts like IRAs or 401k, as well as taxable investment accounts. Let's break it down with an example. Suppose you invest $1,000 in IVV and the S&P 500 rises by 8% over the year. Your investment would grow to $1,080, minus the small expense fee. Now imagine you consistently invest $100 a month in IVV over 20 years. With the power of compound interest and steady market growth, your portfolio could grow significantly over time. However, IVV does have some risks. Since it tracks the S&P 500, it's tied to the performance of the overall stock market. During economic downturns or bear markets, IVV's value will drop along with the index. It's also heavily weighted toward large-cap companies, so it might not capture the growth potential of smaller or international stocks. To balance this, some investors pair IVV with ETFs that focus on small-cap or emerging markets.